Imagine walking into a store and seeing two products that are almost identical. One costs $400, the other costs $600. If the quality is about the same, most people are going to pick the cheaper one, right? So if products from China help Americans buy TVs, smartphones, appliances, and other goods at lower prices, that's obviously good for consumers. But it's not that simple. Washington has another problem to think about. If imported goods become too competitive, what happens to American factories? What happens to American jobs? And in the future, will key industries like semiconductors, batteries, and machinery be built in the United States or somewhere else? That's the dilemma facing America. Consumers want cheaper products, but the government also wants to protect jobs and maintain America's ability to manufacture important things at home. And to understand why China is making that dilemma even harder, we first need to look at what's happening inside the Chinese economy. Welcome to Why Money, where economics becomes simple, interesting, and won't put you to sleep. In July 2026, consumer prices in China rose just 0.5% from a year earlier. Food prices actually fell 1.5%, while core inflation, which excludes food and energy, rose 0.9%. Put simply, if a basket of goods cost $100 a year ago, today it would cost only about $100.50. At first, that sounds like good news. Prices aren't rising much, so people don't have to deal with a big increase in the cost of living. But China's government is aiming for inflation of around 2% in 2026, which means the current 0.5% rate is well below where policymakers would like it to be. There is no perfect inflation rate for every economy, but around 2% is the target used by major central banks like the Federal Reserve and the European Central Bank. It's low enough to keep prices relatively stable, while still providing some cushion against the economy slipping into deflation. And that's the real concern here. A 0.5% inflation rate does not mean China is suddenly facing a crisis. The risk appears if very low inflation lasts for too long, turns into deflation, and people start believing prices will keep falling. Imagine you want to buy a $30,000 car, but you think it might cost only $27,000 a few months from now. You wait. If millions of people do the same thing, companies sell fewer products and may have to cut prices even more. Lower profits can make businesses more cautious about raising wages, hiring workers, or investing in new capacity. Workers then become less confident about their jobs and income, so they save even more. If that cycle continues, it can turn into a deflationary spiral that is very difficult to break. So why is inflation in China so low right now? Part of the reason is that global energy prices have cooled after the shock caused by the war in Iran. But there's another important reason. Domestic demand in China is still relatively weak. And when you look at how Chinese households manage their money, it becomes easier to understand why. Chinese households save around 31% of their disposable income, compared with an OECD average of only about 5.4%. The reason is simple. Many people still feel they need to save a large amount of money for healthcare, retirement, or the possibility of losing their job. When people don't feel completely secure about the future, they tend to hold on to their money instead of spending freely, and the property market has made that feeling even stronger. China's housing market has been struggling for years, and by mid-2026, it still had not fully recovered. New home prices in June were about 3.3% lower than a year earlier. During the first 6 months of 2026, real estate investment fell 18%, while the value of newly sold property fell 13.6%. That matters because for many Chinese families, housing represents an enormous share of their wealth. A 2019 survey by China's central bank found that housing accounted for nearly 70% of total assets among the urban households surveyed. Imagine most of your family's wealth is tied up in a home worth $500,000. If that home loses 3% of its value, you've lost around $15,000 in wealth on paper, even if your paycheck hasn't changed. When your biggest asset is losing value, delaying a new car, cutting back on vacations, or keeping more cash in the bank, starts to feel like a very reasonable decision. The numbers from the first half of 2026 tell a similar story. Per capita disposable income rose 5.2%, but per capita spending increased only 3.7%. In simple terms, incomes are still rising, but spending isn't keeping up. When domestic demand doesn't grow fast enough, businesses often compete for customers in one obvious way. They cut prices. Price competition in China's electric vehicle industry became so intense that in January 2026, 3 Chinese regulators summoned 17 automakers and urged them to stop engaging in disorderly price wars. But Chinese factories don't only sell to Chinese consumers. A huge source of demand is coming from overseas. In July 2026 alone, China's exports jumped 23.9% from a year earlier, helping generate a trade surplus of around $112.5 billion. And this growth isn't only coming from cheap consumer goods. Semiconductor exports nearly doubled, while exports of high-tech products jumped 40.7%, helped by booming global demand for AI infrastructure. During the first 7 months of the year, Chinese exports to the United States rose only 2.6%. But exports to Europe grew nearly 17%, while exports to Southeast Asia jumped about 25%. Strong overseas demand has become an important source of support for China's economy at a time when domestic consumption remains weak. And this is where the trade conflict with the United States becomes even more important. Starting on July 24, 2026, the United States imposed an additional 12.5% tariff on part of its imports from China, officially as part of an effort to block goods linked to forced labor. And that's on top of tariffs from earlier rounds of the US-China trade war, with some products already facing tariffs as high as 25%. So for many Chinese goods, getting into the US market has become significantly more expensive. Chinese companies are adapting in 2 main ways. The first is to rely less on the US market and sell more to places like Europe and Southeast Asia. The second is to move parts of their supply chains overseas. Mexico is a good example. Chinese automakers BYD and Geely took part in bidding for an auto plant in Aguascalientes, with the capacity to produce around 230,000 vehicles a year. If a product is genuinely manufactured in Mexico and meets the rules of origin under the USMCA trade agreement, it can qualify for preferential tariff treatment. But if goods are simply shipped through Mexico in order to avoid US tariffs, American authorities can investigate and penalize that kind of tariff circumvention. And during US-MCA negotiations in 2026, the United States has been pushing for even tighter rules of origin. Mexico itself is also putting up more trade barriers. Starting this year, Mexico raised tariffs on roughly 1,400 product categories imported from countries that do not have a free trade agreement with Mexico, including China. Most of the new tariffs go as high as 35%, while some products, including automobiles, can face rates of up to 50%. On the American side, when the government imposes tariffs, the US importer is the one that pays the tariff at the border. Research from the Federal Reserve Bank of New York found that nearly 90% of the economic burden from US tariffs in 2025 ultimately fell on American businesses and consumers. In simple terms, businesses can absorb some of that cost by accepting lower profits, or they can pass part of it on to customers by raising prices. And that is Washington's dilemma. If Chinese products enter the US market at highly competitive prices, American consumers get cheaper goods, but US manufacturers face more pressure. If Washington raises tariffs to protect domestic production, American companies may get some breathing room, but some products can become more expensive for consumers. So the biggest question isn't simply whether America should tariff China, it's this: how much more are Americans willing to pay in order to keep strategically important industries at home? What do you think? Leave your thoughts in the comments. Thanks for choosing to watch this video when there are so many others you could be watching. If you found this useful or interesting, give the video a like, leave a comment, and subscribe to support the channel and future videos. Thanks for watching, and I'll see you in the next one.